Losing a spouse is hard enough, but almost nobody tells you that the IRS and Medicare quietly change how they see you, starting the next year. Same income, same life, different tax bracket, sometimes a higher Medicare bill. Let's look at what changes. Here's something almost nobody explains clearly. Your tax filing status is worth real money, and it can change overnight. In 2026, a married couple filing jointly gets a standard deduction of $32,200. A single filer gets $16,100, exactly half. If you're 65 or older, you get a bit more on top of that, but the gap stays roughly the same either way. While both spouses are alive, this rarely matters much, because you're filing together and sharing that larger deduction. But the moment your filing status changes, and it will change, automatically, whether you plan for it or not, that deduction is cut in half. Less of your income is shielded from tax. And it isn't just the deduction. Tax brackets for single filers are narrower too, meaning more of your income can get taxed at a higher rate, even if your total income didn't go up at all. This is the first piece of a bigger picture we're about to walk through, because this same married versus single gap shows up again later, in a place most people never expect: your Medicare bill. This isn't a rule that only applies to a few people. It applies to almost every married couple in the country, eventually, because on average, one spouse outlives the other by several years. It's just a fact of actuarial tables, not something anyone likes to think about while both partners are healthy and filing taxes together every spring. Nobody sends you a warning letter the year before. The change simply shows up on your next tax return, quietly, without any notice at all. Here's exactly how the timeline works. In the year your spouse passes away, the IRS still lets you file as married filing jointly, one last time, as if nothing had changed. That's the good news. The change happens the following year. Unless you have a dependent child living with you, you'll typically file as single starting the very next tax year, which, as we just saw, cuts your standard deduction roughly in half and narrows your tax brackets. There is an exception called qualifying surviving spouse, which lets you keep married-style tax rates for 2 more years, but only if you have a dependent child at home, which describes very few people at Medicare age. For almost everyone in their late 60s, 70s, and beyond, the real timeline is short. Married filing jointly through the year of death, then single starting the next January 1st. No transition period, no phase-in. And this same quiet line in the tax code is exactly what feeds into the next number we need to talk about: Social Security. It's worth saying plainly, this isn't a mistake, and it isn't unfair in the way it's designed. It's simply how the tax code has always treated marriage and its end, whether by divorce or by death. But knowing the exact date this switch happens is what lets you plan for it, instead of discovering it by surprise when a tax bill or a Medicare notice arrives. And for a lot of people, the real surprise isn't the tax return at all. It's what happens to the Social Security check. Now let's talk about the other big piece of this: Social Security. Because most people assume that when a spouse passes away, the survivor simply keeps both checks. That's not how it works, and the real rule catches almost everyone off guard. Here's a piece of Social Security that catches almost every surviving spouse off guard. When you're both alive, your household usually receives 2 separate Social Security checks, one based on each of your own work records. Say one spouse receives $2,700 a month, and the other receives $1,800 a month. Together, that's $4,500 a month coming into the house. When one spouse passes away, Social Security does not add those 2 benefits together for the survivor. Instead, the survivor simply steps up to receive the higher of the 2 amounts. In this case, $2,700 a month, and the smaller benefit simply stops. That's a loss of $1,800 a month, or over $21,000 a year in this example. Household income drops. But here's the part that surprises people. Even though income just went down, tax filing status just changed to single, with that smaller standard deduction we just talked about. Lower income and a worse tax position can genuinely happen in the very same year. This is exactly why Social Security recommends calling them directly, as soon as possible after a spouse's death. Not just to report it, but to make sure the surviving spouse is actually receiving the higher of the 2 benefits, automatically and correctly. Mistakes and delays do happen, especially if the paperwork isn't filed quickly. And if you're planning ahead as a couple, it's worth understanding roughly what that gap between your two benefit amounts actually is, because that gap is exactly what disappears the day one of you is gone. Let's put this all together with one example. While both spouses were alive, their combined income for Medicare purposes, pensions, IRA withdrawals, and both Social Security checks added up to $150,000 a year. The married filing jointly IRMAA threshold for 2026 is $218,000. At $150,000, this couple is comfortably below it. No surcharge, no problem. Then, one spouse passes away. The household loses that smaller $1,800 a month Social Security check we just talked about $21,600 a year. Total income drops to roughly $128,400. Income went down. That should be good news. But the survivor is now filing as a single person, and the single filer IRMAA threshold for 2026 is $109,000, almost exactly half of the married threshold. $128,400 is now well above that single threshold, putting her into an IRMAA surcharge tier for the first time. An extra $81.20 a month for Part B and $14.50 a month for Part D. Less money coming in and a bigger Medicare bill going out in the very same year. This is the part almost nobody explains in plain language. IRMAA doesn't just look at whether your income went up or down. It looks at your income against a threshold that's tied to your filing status. And that threshold got cut in half the same year your income dropped. Two things moved in opposite directions at the same time, and most people only find out when the Medicare premium notice actually arrives in the mail, months after the tax return that triggered it was already filed and forgotten. So what do the numbers look like for a single filer? And what can you actually do about it? Let's look at the 2026 brackets, then 3 practical steps you can take. Since the single filer threshold matters most after a spouse's death, here's the full 2026 picture, side by side with the standard Part B premium of $202.90. Below $109,000, there's no surcharge. Between $109,001 and $137,000, add $81.20. Between $137,001 and $171,000, add $202.90, exactly double. Between $171,000 and $1 and $205,000, add $324.60. Between $205,000 and $1 and $500,000, add $446.30. And above $500,000, it maxes out at $487, for a total of $689.90. Part D adds its own smaller surcharge on the same tiers, from $14.50 up to $91. Notice how much narrower these brackets are than the married thresholds. Roughly half the income gets you to the same tier. It's worth keeping a copy of this exact table somewhere you can find it. Print it out, saved as a photo, whatever works for you. Because these numbers do shift slightly most years with inflation. But the basic shape of it, single bracket sitting at roughly half of the married ones, has stayed consistent for years. If you're helping a parent, or if you're the one who may eventually be filing single yourself, knowing roughly where these lines sit ahead of time turns a nasty surprise into something you actually saw coming. So here's what actually helps. First, while both of you are alive, it's worth looking at Roth conversions together, specifically to lower the income a surviving spouse will show on paper in future years, since a conversion done now, while you can still split income across two people, often costs less than the same withdrawal would cost a surviving single filer later. Second, it's worth actually running the numbers on what household income will look like the year after a death, before it happens, not after. So there are no surprises about which IRMAA tier a surviving spouse might land in. And third, remember this from our earlier video on IRMAA. Death of a spouse is explicitly listed as a qualifying, life-changing event for an appeal using Form SSA 44. If a surviving spouse's income drops, and still pushes them into a higher tier only because of the filing status change, that appeal is worth filing. To recap, married filing jointly through the year of death, single starting the next year for most people. Only the higher Social Security benefit continues, and single IRMAA thresholds sit at roughly half of the married ones. None of this is meant to add more weight to an already difficult time. It's meant to do the opposite. To make sure that when that time comes, for you or for someone you love, the financial side of it doesn't add an unnecessary surprise on top of everything else. A little planning now, while both of you are here to do it together, is worth far more than untangling it alone later. So a hard year doesn't have to be made harder by a tax rule nobody ever explained. If this helped you understand what happens to your taxes and Medicare after losing a spouse, subscribe and watch the IRMAA video linked here. Today's build's right on it. Take care of yourselves.